Hi, in this short video I'm going to take you through some of the tasks that are available on the AAT's training and learning portal, and we're going to go through the FAPS Practice Assessment 1. Okay, so once you've launched it, you can see at the top here you've got a timer, so you have 2.5 hours to complete this, and it tells you the tasks that you've answered. Okay, so task 1, okay, it's for 28 marks in total. So again, take note of the marks because this is where you want to pick up as many marks as possible. Okay then, so the important thing that we've got to read in this one is, it says this task is about using daybooks and accounting for and monitoring non-current assets. So your non-current assets are your items that are going to last longer than a year, so motor vehicles, office equipment and so on. So it says here, details from credit notes sent out regarding a prompt payment discount, that's the important bit, prompt payment discount, will be entered initially into the what? Well, if it's a prompt payment discount and we're sending out the credit notes, it's got to be the discounts allowed daybook. Okay, because we're giving it to customers, we're sending the credit notes out. If it was credit notes coming in because we'd paid early, that would then be the discounts received daybook. But on this one, it's credit notes sent out for prompt payment discounts. Details of the cash sales will be entered in. So these are your choices, okay? So when we have cash sales, we enter these straight into the cash book because they're paying immediately. So again, the important bit with this is the cash sales, okay? Because that's basically giving you the answer. If it's cash sales, it's cash book, okay? If an item of revenue expenditure is mistakenly classified as a capital expenditure, what is the effect on the following items in the final accounts? So revenue expenditure is everyday, day-to-day expenses such as rent rates and so on. Capital expenditure is something that's quite unique, so we're buying, say, a motor vehicle or we're buying some new plant and machinery. It's something that doesn't happen that often, but it's used within the business and it's going to last longer than a year. Okay, so if the revenue expenditure has been entered as capital expenditure, well, your revenue expenditure affects your profit and loss account. Capital expenditure affects your statement of financial position. Okay, so if we were meant to put it in the profit and loss and it's gone into the statement of financial position, okay, then what's going to happen is the net profit is going to be increased, okay, because we've not put enough expenditure through, so at the minute the net profit's increased. It's been mistaken for capital expenditure, okay, so it's gone through as a non-current asset. So if, for instance, it were motor expenses and we've put it into motor vehicles, the non-current asset account would be increased. The current assets, it would have no effect on them because it's not touching the current assets. Because remember, your current assets are items that the value will change every day, such as your inventory, trade receivables, your bank account if it's positive, and petty cash. Current liabilities, these won't be affected either because, again, we're not paying for anything on credit. We've not entered anything incorrectly into the current assets or current liabilities. So again, by reading the question, you've gained 4 marks by just making it realistic and putting items to the revenue expenditure and capital expenditure, and then it takes out the thinking from it. Okay. Complete the following statement about depreciation. Depreciation is an example of the use of the what? So you've got three options, okay? Now, always, if you're unsure, go by elimination, okay? Materiality principle means that we will put items through the profit and loss account up to a certain amount. Anything above that then would then go into, say, capitalised items such as non-current assets. Business entity principle means that it's the business and it's the business within its own right, okay? So it's really when we're working with business entities, all the transactions you're posting is to do with that business, okay? But you see, depreciation is definitely the accruals principle. So don't forget, accruals means that we are writing amounts off, or we're making sure that they're written off in the period that they belong to. So things like, I suppose, depreciation, we do that. You can do that on a monthly basis, a yearly basis. So we've got to make sure that depreciation's within the accounts to make the cost of the non-current assets realistic, and also to write off the value of the asset, because as it depreciates, the cost or the net realisable value of the asset will also go lower. You are working for Dev Johnson, a sole trader with a financial year end of the 30th of June. So that's important. Dev is registered for VAT. Okay. Dev purchased a van for his use in his business on the 31st of March for $27,500 plus VAT. He has a policy of depreciating vans using the straight line method at 20% per annum, with a residual value of 10% of the purchase price. The depreciation is prorated for every full month that the van is owned. Okay, so that's really, really important. Then he disposes of the van on the 1st of February 2000X5. Okay, so we need to calculate then the annual depreciation which would be charged on this van. Okay, so remember to calculate the depreciation using straight line method. The calculation we need is the cost minus any residual value times by the 20%, or if it's a number of years, divide by number of years. Okay, so to calculate it, it's got to be 27,500, take off 10%, which is 2,750, which is the residual value, which will leave you 24,750. Okay, so that's the amount that we need to start with. Times that then by the 20% per annum gives you 4,950 per annum. Okay, 4,950. So that's your depreciation charge for the year. Okay. Now what it says is calculate the accumulated depreciation on the vehicle immediately before its disposal. So remember, it says here, we are prorating for every full month. That's important. So every full month that the van is owned. Okay, so we bought the van on the 31st of March, so that's not a full month. So we're going to start from the 1st of April 2023. So I'm using 23 just to fill in blanks. So if we use the 1st of April 23 to the 31st of March 24, that's 12 months. And then if you use the 1st of April 24 to the 31st of January 25, which is the day before we sold it, that gives you 10 months. So you've got 22 months in total of depreciation you've got to calculate. So the way to calculate this is 4,950, that's a year, divide that by 12, and then times it by 22, you will get 9,075. Okay, so that's the accumulated depreciation on the vehicle just before we disposed of it. Okay, then it asks us to complete the disposal account. So you'll have done this in your studies, and what you've got to think about is always keep thinking about the double entry. So if you know that a motor vehicle is an asset and was a debit, when you get rid of the motor vehicle, you've got to credit the asset account, debit disposal. Okay, so just keep thinking you've always got your debits and your credits. So for instance, if accumulated depreciation is a credit, to dispose of it you need to debit accumulated depreciation and credit disposals. Okay, so your double entry works all the time. So what it's saying is Debs purchases a new van from Pete Smith on 1st February 2025. Trading in the old van as part exchange. The list price of the new van is 36,000 plus VAT. He receives in part exchange 9,500, and then he pays the balance using bank transfer. Okay, so that's the important bits that we need to take from this. Okay, so the first thing we need to do is see what the old van originally cost us, which was 27,500. Ignore the VAT because they're not asking you to do the VAT account at the minute. Okay, so what you're going to do is in your motor vehicle account there would be a debit of 27,500. So to remove the disposal you need to credit your motor vehicle account and debit your disposal account 27,500, and don't forget then to click on, I believe is there a little arrow? Let's have a look. Take my highlighter off. Then you pick from the list of which one it is you're looking for. So you're actually looking for a vehicle at cost. Okay, then what we've got to do is we've calculated the accumulated depreciation. So accumulated depreciation would have been a credit, so you would now debit the accumulated depreciation account and credit your disposal account to close down the accumulated depreciation. So we're taking out the accumulated depreciation of the old vehicle that is no longer with the company. Okay, it says here that we got 9,500 in part exchange. So that's like receiving it, you know, if you were receiving it in cash or bank transfer, it would go straight into your bank. But what we're doing is we're actually not receiving the 9,500. We are getting the money for a vehicle that we've traded in. Okay, so what we've got to do is we've got to put the 9,500 into the disposal account, and this will be your vehicle at cost account. Okay, and the reason for that is because that is part of the new vehicle, so the double entry to that would have been debit vehicle at cost account 9,500 rather than receiving any cash for the selling of the asset, which you would have put then is in the bank account as a debit. Okay then, so the difference between the 27,500 and the 18,575 is 8,925. Okay, this is going to be transferred to the statement of profit or loss. Okay, so if it's on the credit side, okay, of the disposal account, that means it's going to be transferred to the debit side of the statement of profit and loss. And if it's transferred to the debit side, it means that we've made a loss because it becomes an expense in the profit and loss account. Okay. The next one is how much does we need to bank transfer to pay for the rest of the vehicle. The amount we need to calculate is the 36,000 plus VAT, which gives you 43,200, minus off the 9,500 part exchange we've received. So the amount of bank transfer would then be 33,700. Okay, and it's quite straightforward to gain those two easy marks. You just need to remember that you've got to take into account the vehicle at cost part exchange you've received. Dev is recording a profit or loss in the account. Well, a gain or loss, should I say. Remember what I've just said. If it's on the credit side, you're bringing it down onto the debit side of the P&L, which would mean it's a loss. Okay, prior to adjusting for depreciation, an extract of Dev's trial balance is as follows. His policy is to use the reducing balance method, 20%, on the value of assets, assuming no residual value. There has been no adjustment for depreciation. Okay, so reducing balance method. This bit has been thrown into throw you off guard, I think, because when you're using reducing balance, we don't take into account residual value anyway, purely because when using reducing balance, it never gets to zero. It'll just constantly keep going. The value will just keep reducing, but it'll never get to zero before you get rid of the asset. Okay then, so to work out the depreciation then, so if it's based on reducing balance, it means that it's the cost, which is your 47,857, minus your accumulated depreciation. Okay, so you've got 47857 minus 18280 equals 29577. So that's your net book value or carrying amount. It says then it's 20%, so times that by 20%, which means that the depreciation charge for the year would be £5,915.40. Okay, depreciation is an expense, so you want to debit the depreciation expense account, and then you would credit the accumulated depreciation account for the office expenses. Okay, and that's basically that one done. So remember, we're reducing balance. Don't let the examiners throw you out with this residual value. Identify now whether each of the following statements could have caused a discrepancy. So Dev is trying to reconcile his general ledger to the non-current asset register. He is looking at fixtures and fittings. The balance in the general ledger after depreciation is 72,382. The balance on the non-current asset register has a carrying value of 65,282. So it means that on his general ledger in the accounts, it's higher than what's actually on his asset register. Okay. The statements are: depreciation for the year was omitted from the ledger accounts. Okay. So these are the ledger accounts, the general ledger. So if you've got to enter depreciation and you forget to do it, then this figure is going to be too high. So it's not going to give a true carrying amount. Okay, so that could cause the discrepancy, because when you put the depreciation into the system, it's going to reduce this amount. Okay. An acquisition was included with VAT in the non-current asset register. So in here, it were included with VAT. Well, if it were included with VAT, I'd expect to see that too high. Okay, because obviously we don't put the assets into the asset register with VAT because VAT is not our money, so we ignore the VAT. So if it had have got VAT on, it would have made this register too high, so it can't have caused the discrepancy. Okay, so that is just me talking you through task 1, which is worth 26 marks. Okay, now if you can work through that and, you know, go through it at 28 marks actually, sorry, go through that step by step, it really is a good start for the exam. Okay, so just take out of it what's important. All right. I'm not saying don't read all the tasks, because you must read it. And as I always say, RTFQ, read the flipping question. Okay, because there's always information in there that will try and throw you off. Okay, so that's task 1 done, 28 marks, and then you submit your answer.